Welcome to the AIER's Authors Corners podcast. I'm your host, Ethan Yang, and today we have a great guest, Professor John Wood, who is a professor of economics at Wake Forest University. He's served in positions on various Federal Reserve boards in cities across the country, as well as taught at a multitude of different schools, such as the Wharton School at the University of Pennsylvania. Dr. Wood has also been a scholar with the American Institute for Economic Research, so we are happy to be having him back on this podcast. And today we'll be talking about a pretty relevant topic today, given all the various things in the news regarding monetary policy, banking, the Federal Reserve, you name it. He's written a book that was published a little around 2000. It's called Monetary Policy in Democracies, which he's going to share very, very relevant information that dates back hundreds of years, but is so much more relevant today, given all the things in the news. So without further ado, Dr. Wood, how are you?
Very good. Thank you. Thank you for having me. Some of my most enjoyable times have been spent. I spent about a dozen summers at AIER in 1998 sort of to 2010.
And it's definitely great to be working with you today as well. So let's get right into it. You spent many years studying the topic of sound money. That's a topic of tremendous importance. Obviously, at AIER, we have something called the Sound Money Project. But the average person probably hasn't really given this a second thought, even though it affects our lives every single day. So just to start off, can you explain what sound money is?
I think of it, and I think generally people think of it as stable money, money with stable value. That if it's worth something, if a dollar is worth something today, it'll be worth about the same tomorrow or next year. Stable money, I think, is what it's meant. And it's associated with, I guess, with conservatism. Inflation has a large effect on the wealth of a lot of people. And a stable society has a hard time with changes in the value of money. That is, with the lack of sound money. I think that's about a very simple concept. I think that people don't pay much attention to it because in the United States, anyway, in Western democracies, it hasn't made a lot of difference. I try to get my students excited about inflation. It's eating into their pursing power. I don't think they lose any sleep. It's been made up for in our productive society by wages going up faster than prices. So that in general, we've done well. Your grandfather tells you that a quart of milk was 10 cents when he was a boy, but he hasn't been hurt. But it does hurt parts of society, business people, because inflation doesn't proceed at a steady rate among all goods and services. So some people are hurt by inflation.
So in your book, you talk about how monetary policy and money has always been closely watched by the state, going back hundreds of years, even when we were on the gold standard and even during like the imperial era when European countries were using gold, the government's always been watching the money very closely, has always kept a close hand on the policy. So can you explain why that's something we should be concerned about and what are some shortcomings to that approach?
Well, I guess the short answer is we would all like money, and governments have the power to take it. The silver mines outside Athens were controlled by the government. Athens had a stable currency for hundreds of years as long as the silver held out. We're all short of money. I mean, we all have money problems. Now, I start with my own understanding of democracy. In a democracy, the people, more or less, run things. They're supposed to run, and we want, and I'm a free market kind of guy. And most things are done and can be done without government, but government may provide services. Different people want different services, roads, whatever. And we tax ourselves to provide those services. We pay for them, we agree. We argue about what services we want and how we're going to pay for them through taxes. Well, we don't like to pay taxes. Basically, Americans, like other people, want more from the government than we're willing to pay for. So we provide, our Congress, our Democratic Congress, spends more than it takes in. We're unwilling to pay that. Like these stimulus packages, which are going on now, they should be, there should, if it's a good idea, have these stimulus, we should be paying for them. Actually, it should be in our bill. It should be added to our taxes this year. But it's not. We're not really concerned with that. So the governments, it starts with fiscal policy. Governments have a hard time raising money, so they borrow it, or maybe they even print money. And Adam Smith's book, The Wealth of Nations, was to a large extent a criticism of mercantilism. People were trying to accumulate gold. Gold is power, it's purchasing power. The governments are short of cash, especially in an emergency, especially in wartime. They're always short of money, and they have the power to take it. And we let them. I tell my students, when I say they, I'm always criticizing they, but it's really we. Governments can do what we let them do. And money is power. And the things sometimes were worse. Most inflations, most financial crises, most debastements of money have taken place during wartime. They print money to pay their soldiers. It doesn't always happen. There are groups that want stable prices. And it's a contest now between balanced budgets and printing money. So it's been a continual battle.
And you are of the opinion that we should decentralize all this decision making. We should give more power, take it away from the central government and spread it out over society. And then obviously the perfect system would be a market-based system where everything would be basically managed through market transactions and rather than a central governing agency. So can you give an example of what that would look like? Because we are so far away from that sort of system. Can you give an example of what that would look like and why would that be a preferable system?
Okay, to tell you what it would look like if the monetary system for many, many years had a lot of the trappings of free markets. The government would issue a basic currency that would define, like in the United States for many years, an ounce of gold was $20. So money was gold. But we don't actually deal in gold. We deal in claims on gold. We could get it if we wanted it, maybe. So if the government stands ready to mint gold, to make coins out of gold, so they'll make a shilling. In England, they would make a gold pound or sovereign, it was called. And it had a particular weight, and it prevented other people from doing that. It had a monopoly on minting money, just like today. It's a criminal act to reproduce even the equivalent of a dollar bill. You can't print money. But once that gold is out there, it's a good. It's a free market good, and I can borrow that. Some people have more than they need, Some people have less. There are savers and investors and financial intermediaries. And savers will invest in bond promises, which businessmen and other people want that, will borrow that. And if these are dollars, say $20, but that's an ounce of gold in the 19th century, before we went off the gold standard, basically in 1933. So banks can arise. They need charters, but really the system was pretty competitive. People saved, invested. There was this pieces of gold that had a particular value. But that wouldn't, government's not necessary for that. Government's not necessary for that. The value of money under this gold standard was determined by the cost of producing gold. So the gold standard is conceptually completely a free market, and in fact, it was to a large extent a free market. And you wouldn't even know, actually. People who live under the gold standard dealt in dollar bills. They were converted, people would sometimes carry around a silver dollar or gold coin and so forth. But by and large, they lived just like we do. They wrote checks, they borrowed and lent, and it was cash. And there were problems from time to time. I would set up a bank, and I'd have people deposit money with me, and then I would lend it out and hope to make money on the difference. And maybe I would lend out more than people deposited with me. And maybe people want their money back. Maybe they want their gold. So you can have financial crises. I think under any system, you're going to have some. The future is uncertain. People want to take a chance. In fact, I hesitate to complain about speculators because Americans take. I'm really a free rider. There are people out there taking chances. Sometimes they fail. I'm just a college professor with tenure. I don't invest in anything risky. So I've been taking advantage of people who have taken risks. But fundamentally, you wouldn't even know, except you wouldn't be having inflation. The value of money would be tied to the value of gold. Now, if the government just shut down, my own principle, public policy position is to close down Washington and take off from there. Sometimes I'll ask my students, what are the post, it's no longer a relevant question, but before FedEx and all that stuff, I said, what will happen to mail if the government shuts down? There might be a day's delay in your first letter, but that would be filled up. That service would be filled immediately. And so would money. We would deal with the gold standard. There would be competition in terms of the best forms of money. Basically, I'm going to print some currency. The John Wood First National Bank currency. In the old days, banks had currency varied from bank to bank. They had, I'm going to print some currency which you'll maybe find useful in transacting, but it will be backed by something. In the 19th century, years before, it was backed by gold or silver. And so money would be market determined. I'm a fan of Milton Friedman in many respects, but he come with lots of people. He wrote books about the benefits of markets, free enterprise, except money. We don't want money to be determined by the market, and we want it to grow at a particular rate. Maybe it's an attempt to make up for fiat money, but he sort of later, other people, Hayek and one of the Kleins, wrote, Larry White wrote books about the benefits and the possibilities of free market money, and we would just get up in the morning, do our usual thing, and life would be simpler because prices would probably be more stable.
Mm-hmm. And then you just went over how the market would make things more efficient and also more competent. But there's also another problem that you outline when it comes to central banking controlled by the government, and that's political issues. And you've mentioned how banks throughout history have always been closely connected to politics. So can you explain why politics plays a role in central banking and why that's a bad thing?
Yeah. Well, of course, it's inevitable. All of our institutions are affected by politics. They're established with political frameworks. The Federal Reserve, in particular, though, people talk about the independence of the Federal Reserve, which is probably an impossibility. It's a government agency. It's really part of the administrative state, which really got accelerated under the New Deal. We really don't have much of a democracy sometimes. When Congress they pass very, very general laws with all the details filled in by separate agencies. We're pretty far from the wishes of the electorate. We don't need a Federal Reserve. We don't need a central bank. And the United States did not have a central bank or anything like a central bank between the end of the second bank. Andrew Jackson did away with it. Second Bank of the United States. Its charter elapsed in 1836. And some people tried. It was an issue. But the United States could not get a central bank. It was the New York wanted the central bank. The rest of the country didn't trust J.P. Morgan to run the banking system. So the Federal Reserve was then founded in end of 1913. So there's 97 years without a central bank. Really, the biggest influence on money, was the biggest trader in money, and that was the U.S. Treasury. The government was smaller in those days than today, but it was still the biggest actor in the law. And it dealt, by and large, in gold and silver. The Treasury held a lot of gold. And people paid taxes, and lots of money was in gold. So the Treasury's activities affected what we would call the monetary base. Gold is the monetary base, or high-powered money, because other kinds of money, demand deposits and so forth, have reserves of gold. So if I pay taxes in gold, that takes money out of the system. That's a problem. And the U.S. government ran a surplus most of the time in the 19th century. Only during a couple small wars and the Civil War, we ran large deficits. We mostly ran surpluses, so the Treasury accumulating gold, and this problem was to get it back out there, not to disrupt the monetary system. And gold was dug up from the ground. I mean, gold, the production of gold was determined by market forces. People were looking for gold. It wasn't completely luck. Like in any enterprise, there's a lot of luck. But after a period of deflation, like all of the first 50 years of the 19th century, when prices were falling, gold was becoming more valuable. So people were looking for gold. It's not an accident that the California gold rush and the South Australian gold rush happened at the same time, or that the South African technological developments in mining gold happened after a period of deflation. So that's another advantage of the gold standard. It tends to be stabilizing, not perfectly. Now, a central bank can be helpful. Okay, here's why one of the reasons why we might have central bank. The Bank of England was a true central bank. The Federal Reserve is not even a bank. A bank takes, monetary authorities tend to be called central bank. But the Bank of England had a charter from the government, and it lent money to the government. It was truly a central bank. It had special privileges. It was located in London, and banks around the country had deposits in the Bank of England, just like it performed much of the same function that New York and Chicago performed in the 19th century, because banks, smaller banks, keep reserves on deposit with central banks, Chicago or New York. And the Bank of England developed a practice of helping the other banks. People lend too much. And a problem with banks, although I think it's exaggerated, is this sort of systemic risk. If one bank fails, another bank might fail. If people get worried about their banks for whatever reason, they start to hoard cash. And Henry Thornton and other people have written great books about the money markets, centered on the money markets. A pays B, B pays C, C pays A, and they better pay in a hurry because debts are coming due all the time. And if people worry about banks or if there are failures, people have a hard time raising cash, and maybe people withdraw their cash from financial institutions, keep it under the mattress. They hoard the beginnings of the shortage of cash, like anything else, toilet paper, whatever, the hoarding. And the Bank of England gradually developed a system, reluctantly and incompletely, of help. It was called lender of last resort. Maybe if the banking system will be easier lending to help you guys out. And so it may be that a central bank or a principal bank, or more than one, will be useful in stabilizing the system. Because if banks fail, business doesn't get down. Any other industry can fail. That's hard. But if banks fail, business can't be done. Half of every transaction is cash. And the England developed a reputation, became very stable, unstable in the early years. Larry White talks about this in Scotland and compares, they had an unregulated banking system in Scotland, which was stable. But the English system was working very well at the end of the 19th century. It was kind of the envy. And we were having bank panics. Those, I don't know, it's another long period of time to discuss those. So a lender of last resort, someone who stabilizes the financial system, might be a good idea. And it was a very tough sale in the United States. There was a lot of local antagonism toward the financial sector. And you know the era of William Jennings Bryan and so forth, the finance, the two principal political controversies at the end of the 19th century were money and tariffs. And and we had, well, in 1920, we had 20,000 banks. Nebraska, I can remember, but Nebraska with 1 million people had 1,000 banks. These are 1,000 separate banking companies. And if the price of wheat falls, and all your customers grow wheat, basically, grow wheat or deal with people who grow wheat. So if the price of wheat falls, you're in trouble. You're undiversified, mostly. So really what we should have gotten was we should have followed England and everybody else in allowing branch banking. Although I have to kind of stop and think about that a little bit. So now we have branch banking, which seems to have brought other problems. But no way were we going to have branch banking. Depressions, or no way was Congress going to allow branch banking. Even after the Great Depression and failures of banks, FDR, no way we're going to have branch banking. We're getting it after the crises of the 1980s. But a central bank can help stabilize the system. But it doesn't have to be an official central bank. But the Bank of England, it's hard to say, that they had official responsibilities. They were a private bank, but they had a government charter and they had some government responsibilities. So it can provide a function, but it doesn't have to be official. And with political problems, it's a government agency, okay? Like if you would consider, we're going to have changes now with the change in administration. If you consider the EPA or the SEC or just about any government agency, it's going to be affected by the politics of the group in power. Maybe not enough, because we should be running things. Congress is not doing its job. It's our effect and the government's effect on money and other government projects are complicated because of the administrative state. But there's always this pressure. People keep saying that Trump was new in fighting with the Fed. No president has ever seen an interest rate that's too low, especially when an election is coming up. So let's take Lyndon, a good example is Lyndon Johnson. Well, the Vietnam War. This is a fairly unpopular war, getting more unpopular as time went along. The administration wanted to continue the war, and they were lying to the American public day by day about the progress of the war, the Bay of Tonkin Revolution. And Congress has this tendency, it's pro-military. As Obama said, this town has a tendency toward war. The military, I'm not anti-military. I'm not opposed to the United States having enough power for it. Depends on your goals, of course, but it has a lot of political backing. But in Vietnam or Afghanistan, Congress is willing to sort of support the troops. But we don't want to expand the war. But Johnson wanted to expand the war. He wanted money, but Congress wouldn't raise taxes. So he had to borrow, and he didn't want to pay a high interest rate. So it was a continuous battle between the Fed, Martin, the chairman of the Fed, a stable money guy, constantly fighting with Johnson. And even in the 50s, just one example here. Now Ike was not a big money guy, but he wanted economic prosperity when running for an election. And the Fed had a policy, okay, they're now supposed to stabilize the economy. When they were formed, that wasn't thought. That's what the jobs of the Fed were originally. It was to provide an elastic currency. We want to support banks and the money supply. The idea of Phillips curves and so forth like that, but that's a post-Keynesian idea. So the Fed was leaning, what should we do? Leaning against the wind. So the economy is not doing well, we'll pump up the money supply. If it's doing very well, we'll hold it back. And that was sort of the Fed's policy, but it was asymmetric. See, the Keynesian idea of supporting the economy is not necessarily inflationary. You're supposed to run a deficit during bad times, and a surplus during good times. And Keynesianism is not inconsistent with a long-term balance, but it's asymmetric. When times are bad, we're worried. So we pump the money in, we spend money. When times are good, we don't actually cut back that much. And it's interesting, if you read the minutes of the FOMC, you can see these arguments. Martin always losing the argument. He said, well, okay, if that's what you want, but we should cut back. Constant pressure. And remember the Fed. The Fed is an agency of the federal government, and if they make Congress, their best defense is disagreement in Congress. There's some tight money guys, some easy money guys, but you don't want to get Congress as a whole. They can change you. They can do away with you. The pressure. And it varies because there are guys, the banking system as a whole, I think, wants stable money. I mean, if you're a bank and you lend money to somebody, you want conditions to be the same during that time of that loan, so he'll be able to pay you back. Some people like a stable system and some people don't. Congress just but they do it because of it's not Congress, it's you and me that press that, and the Fed worries about it. It's not independent. You can't. Well, no, the word is meaningless. I mean, independent of what? They usually mean independent of the Treasury, which it's constant pressure, and I don't. Yeah, I'll better stop there.
Okay, and I've saved the juiciest and most existential question for last, and that is, as a monetary expert with decades of experience, right now we're seeing quantitative easing like we've never seen before. We've seen interest rates stable to the floor. Cryptocurrencies are now worth tens of thousands of dollars. So just looking at all of this, the question on my mind, and probably many others, is that does this have any precedent in history, at least from your investigation? And what's happening? Like, what do you make of all this? Is this the end? Is this a new beginning? What's going on?
Well, I'm an unrepentant optimist. There was a joke in the 19th century that God looks after drunks and Americans. Somehow things will work out. And if you have a society as productive as we are, I mean, our economy is just taking off, getting richer all the time. So what Adam Smith said, the relationship of the public to his government is the same as that of the patient to the doctor. It gets well in spite of it. Now we could pay another quote from Adam Smith. He knows of no case in history, there's a lot of history in wealth of nations, in which a substantial debt was ever paid. It was usually, often repudiated, more often by inflation. We had, I think, maybe a bigger debt in 1945 relative to GNP than we have now. And we inflated it away, basically. sort of historically. And we could pay it off if we wanted. They have that thing in New York where on a building which shows the size of the deficit. And in the 1990s, it was called the peace dividend. We were running surpluses under Clinton because of the decline in cut back in government spending. And they were worried about what's the Federal Reserve going to do when there are no government securities left to buy and sell, even though the Bank of England dealt in private securities. I don't know. In the past, they've inflated the debt away. But people don't seem to buy it. For a while, for several, people would say something about the deficit in any election, ask people, what are your concerns? And the deficit would be mentioned. Now they don't even mention, they don't even pretend to be concerned with the debt. So I guess that's basically saying that I don't know. And actually our debt is greatly understated. If you look at the statement of the debt, the big parts of the debt are, if these guys were private, they'd be in jail. Like the looming Medicare and Social Security obligations aren't even counted because they're not written down. They're not like bonds, but they're claims that are going to be. So I mean, we could repudiate the Chinese and Japanese have bought a lot of our debt. There will be some crisis. There will be something that won't be thought out. People can think about it. But anyway, I don't know. But I think we'll still be rich. The bondholders historically, and as Keynes said, the rentier, he kind of liked inflation. It takes money away from those people who have too much. That's not something, that's not a view I share. But inflation has, it's an age-old thing. Even if you go from Babylonian time, recorded history from the times of ancient Greece, even up to the end of the gold standard, prices had a tendency to come up a little bit. Now the dollar is worth a nickel. If you talk about how's the Fed done, there's a bias toward institutions. People bow down before institutions. I try to persuade my students not to do. If it's an institution, it must be okay. But the dollar is worth a nickel compared to what it was worth when the Federal Reserve was created. So it's clearly not doing its job. But then it's been pressed, and it's an agent of the government, the federal government. And we get along, as the public gets along as well as it can, in spite of the government. And things are worse other places. I suppose that's our justification. But as far as if we were just willing to pay for what we wanted the government to do, that's got to be the basis. Right? I mean, we've been buying services like okay, I'll finish with a couple of examples. In the Civil War, in World War I, and World War II, we're going to spend a lot of money. Okay. And we raised taxes. The marginal tax rate was more than 90% during World War II. During the Vietnam War, Well, we had the Kennedy tax cut just before the war started. Basically, taxes were reduced before and during the Bush, the younger Bush, and his tax cut practically at the same time. We went to so we spend more money and reduce revenue. Taxes have been falling almost continuously since 1945. It's just been like we call it the Kennedy tax cut was to promote demand. The Reagan tax cut was a supply side tax cut. It doesn't matter. They were tax cuts to Americans, which we like. And obviously that has to change. We could pay it off. There could be a long-term plan. But as I tell my students, congressmen are different from you and me. If I save money today, it promotes my well-being tomorrow. I save that money, I want to have it tomorrow. If a congressman doesn't spend today, well, I mean, that goes to somebody else. He needs it for the election now. They have no. We did it during the 19th century. When people say we could do the gold standard worked fine. There was plenty of gold. The gold supply grew during the 19th century before that. It grew at about the same rate as the world's population. Of course, there was a shortage of gold in the sense that we're all short of cash. We wish we had more. But it would take, and I think it's democracy. We're not willing to pay in taxes for what we want the government to do for us. I'm short. I mean, how you can persuade people of that.
Yeah, thank you for that answer. And thanks again for a fascinating conversation on this very relevant topic. To our audience, Professor Wood's book is called Monetary Policy in Democracies. It's been published by AIER and available on Amazon or wherever you get your books. Thanks again for tuning in, and please look out for our next guest. Thank you.
Thank you.